In this video, we will be finding the variable manufacturing overhead rate variance and the variable manufacturing overhead efficiency variance. So here again, we're using the same company, so all the same assumptions. So it says Glacier Peak Outfitters uses direct labor hours as the allocation base in its predetermined overhead rate. The company has the following standard variable manufacturing overhead cost for each mountain parka. 1.2 standard labor hours per parka at $4 per labor hour, so $4 of variable overhead. Last month, employees actually worked 2,500 hours to make 2,000 parkas. Actual variable manufacturing overhead for the month was $10,500. So here you're seeing that, well, why is the 1.2 standard direct labor hours the same as when we did the variances for the labor rate and labor efficiency variance? Well, here they tell us that the allocation base for the poor is direct labor hours, so that would be the same. It makes sense that that is the same, that the 1.2 standard direct labor hours that should be used per parka is the same for the labor rate and efficiency variance and the variable manufacturing overhead rate and efficiency variance, since direct labor hours is the allocation base for the poor. Okay, so once again, before we get to filling out the diagram, you want to find your standard quantity, or in this case, the standard hours. And this will be the same as the standard hours for the previous video that we did on labor. So they tell us that we should be using 1.2 standard labor hours per parka, and we actually made 2,000 parkas. So knowing that, how many hours should we have used? Well, we take those 2,000 parkas and multiply it by the 1.2 standard hours we should have used per parka to get 2,400 hours. So that's how many hours we should have used in total to make all of those parkas. So let's first focus on the variable manufacturing overhead rate variance. So this is where we compare what was actually spent in terms of variable overhead for the period and what we should have spent. So the 10,500, once again, I'll work backwards a bit to find out on average what this company ended up spending in terms of variable overhead per direct labor hour. So we take the 10,500 spent on actual variable overhead and divide that by the actual direct labor hours of 2,500. So we can see here that the company actually spent about $4.20 in terms of variable overhead for each direct labor hour used. So we're going to compare that 10,500 to the actual hours times the standard rate. So we're going to take those actual hours of 2,500 hours and multiply it by what should have been incurred per direct labor hour in terms of variable overhead. So the standard rate for variable overhead is $4 per direct labor hour. So if we actually use 2,500 direct labor hours, that means we should have spent about $10,000 in terms of variable overhead. So let's compare what we actually spent to what we should have spent when having that many hours. So we can see here we spent $500 more than we should have based on standards. So here there's a $500 difference. And what's the thing that's differentiating these two numbers? It's not the AH, because we're using the same actual hours. We're using different rates, right? We're comparing the actual rate to what the standard rate is. So there's a 20-cent unfavorable rate variance here per direct labor hour, and that comes out to a total unfavorable rate variance here of $500 because we ended up spending a little bit more on variable overhead than we should have spent given that level of direct labor hours that we actually used. Now let's find the variable overhead efficiency variance. So remember, this is where we compare the hours used to the hours we should have used, right? That's why when it comes to the rate here, when we convert it to dollars, we use standard rate because we're not focused on the rate difference here. We're focused on the difference in hours used. So we actually used 2,500 hours. So we're going to multiply that by the standard rate of $4 to get 10,000. We're going to compare that to the 2,400 hours we should have used times that standard rate of $4 per hour. So if we look at the actual hours times standard rate, we get $10,000. And when we take the standard hours times the standard rate, we get $9,600. So there's a variance here of $400, but it's unfavorable. Why? because we used 2,500 hours when we should have used 2,400. So there's, in terms of hours, that's a 100-hour unfavorable variance, but converted to a dollar basis, and a 100-hour unfavorable quantity, or in this case efficiency variance, converts to a $400 unfavorable efficiency variance when we use that standard rate to convert it to dollars. Now the two unfavorable variances, the unfavorable rate and the unfavorable efficiency variance here in terms of variable overhead, add up to a $900 overall unfavorable spending variance. So we can see here the process is basically the same, whether it's materials, labor, overhead. It's just some differences, some small differences, depending on what we're working on. So one thing that I just want to mention, just to make sure we clarify, when we look at that $4 per hour standard rate for overhead, remember, when we're talking about variable overhead, and especially if the allocation base is direct labor hours, it's not that for every direct labor hour the company is charged or should be charged $4 of variable overhead, right? That's not how it works. But that $4 means that on average, how much variable overhead cost should one direct labor hour cause? Because remember, it's not just the cost of wages. When we're talking about direct labor, there's a bunch of other things that the company incurs because of having labor. There's a bunch of other incidental costs, right? We have the cost of, for example, the utility bill. Or we also have indirect laborers that are required because we have direct laborers. For example, what about the janitorial staff? Or the cost of maintaining or cleaning or prepping the machines. So anything you can think of that's part of overhead. So remember, overhead is anything that's not direct materials or direct labor. All of those costs are necessary still for production to keep going and for us to actually support direct labor, right? There's a bunch of costs that we have to incur as a company to support that function of direct labor. So when we're looking at this $4 per labor hour of variable overhead, it's not that the company is directly charged that, right? That's not how it works. But basically what that refers to is that for every direct labor hour, how much variable overhead cost should the company be incurring because of that one direct labor hour? Because basically every direct labor hour that the company uses causes other costs to be incurred. So here we're saying we should have been incurring about $4 on average in variable overhead per hour, but we can see here that we ended up incurring a little bit more of variable overhead per hour. And usually the 420, for example, remember, you can't figure that out until after the fact, because variable overhead is made up of a bunch of different things, right? We add up, for example, all the invoices and all those costs together at the end of the period to figure out what variable overhead it ended up being, and then we can figure out on average what that really comes out to per direct labor hour, because it's made up of so many different things. All right, so that's how we find the variable manufacturing overhead rate and efficiency variance. So we've so far looked at all the price and quantity variances for all the variable production costs. So in the next video, we'll look at how to find the variances as it relates to fixed manufacturing overhead.